of the 2020 Marketing Seminar, which is a program of the North Dakota Grain Growers Association and the Minnesota Association of Wheat Growers. This program is possible through the support of our members. Please consider becoming a member of your state wheat organization. Membership details can be found on the websites ndgga.com and mnwheat.org. We'd also like to thank our sponsors for today's program, A Country Farm Credit Services and the Northern Crops Institute. Our next speaker is Bret Oekle. Bret is the owner of Innovis Agra, LLC, an agricultural business consulting company that provides business management services to agricultural producers and businesses that support them. Bret is retired from the University of Minnesota Agricultural Business Management team. Bret received his BS degree in Animal and Range Sciences from South Dakota State University and his Master of Agribusiness degree from the Department of Agricultural Economics at Kansas State University. Please welcome Bret.
Thank you. So we talked a little bit about what I should address here today, and the theme was profits through intensive marketing. But as far as I'm concerned, it is just trying to generate profits through marketing. Because as you've seen with some of the data that's been presented so far today, it can be a little bit of a challenge to come up with enough revenue to cover the costs that we incur in producing wheat, corn, soybeans, sugar beets, and the other variety of crops that we raise here in the Northern Plains. So we're going to quickly address an overview of marketing philosophies. We're going to spend a fair amount of time on data-driven strategies that we utilize with some of our customers. And then we'll look at some of the old and new crop and new crop price targets that we're utilizing on the farms that we work with. So let's talk about these marketing philosophies. And a lot of this is dependent on what stage in your career you are and what level of debt that you carry. So traditionally farmers have been cash forward, hedge to arrive. Some of these elevator-based tools, they market that way. Generally, low-cost farmers can get along well in this scenario. Farmers that are adverse to margin risk, and I say that a little bit tongue-in-cheek because margin risk is psychological as far as I'm concerned. There's a lot of farmers that do not like to have margin money come out of either their cash flow or their operating line of credit, or if they've got a separate hedge loan set up, it drives them crazy. But if they've got a well-written and well-thought-out risk management plan in place, and they're making incremental sales in an increasing market like we see in soybeans right now, they're going to invest both initial margin in any of the futures positions that they get into, and they're also going to invest it in maintenance margin on their earlier sales. The last few days, I've been getting deluged with texts and emails from growers that haven't had to spend any money on margin recently because prices had been flat to declining, that suddenly are tapping into risk management loans, and it's making them nervous. Well, that's good news because that means we're selling into a price rally. And there's a lot of farmers that don't have the right outlook when it comes to margin, or they don't have access to enough cash to be able to hold those positions. So a lot of times we're forced into that position. A lot of times it's just growers that are very low cost that don't want to or don't have to take that margin risk. Farmers that use futures and options, these are used by farms that choose to have more flexibility. It allows them flexibility to make different delivery locations. It's interesting, we've got some local folks making calls around asking farmers in the Southern Valley, what kind of basis do we have to offer for you to enter into either cash forward contracts or basis contracts for January, February delivery off of March corn futures? And I keep telling these guys, tell them 35 under, just to see what kind of response you get. We haven't been able to crack that yet, but I did hear recently that we did have at least one train of corn sold for a basis that would have been comparable to that. And it took about 15 minutes to fill that train at something in the 30 unders south of here. So if you use futures and to a certain degree options, that will give you the flexibility to be able to deliver into those cash markets or those basis markets that are better than perhaps they could be if you're in an elevator that isn't forced to be as competitive. Some of the data-driven revenue generation philosophies are for farms that have an understanding of price relationships, price movement, and have an excellent handle on cost of production. And boy, I tell you, that's really, really critical. And by the way, we take a look at cost of production several times throughout the year. We've started our 21 budgets a couple of months ago. As soon as we start getting fertilizer prices for fall application or payment January 1st or DEES 31, we'll start building those budgets and try to take a look at what changes we might take a look at. We'll revisit those budgets again sometime after harvest, and then we'll take a midsummer look at things and say, how are we doing? Have we spent more or less than what we expected? Does it look like the crop's going to mature? And what impact will that have on our total costs? And then what kind of yield are we expecting? And I would say right now, we've got a pretty good idea of what our corn yields are going to be. Soybean yields, I think, are still a little bit uncertain. Most of the wheat is harvested, so we kind of know where we're at there. And sunflowers and some of the dry edibles we're just starting to think about. So what we've found is that if we have growers that are going to outgrow their budgeted production on any of the three primary crops that we're going to talk about here today, we can see some fairly significant reductions in our cost per bushel. And that can make marketing considerably easier. Now, on the other hand, if we grow underneath our projections, our cost per bushel goes up. And that creates some additional challenges. But again, the marketplace doesn't care what it costs you to grow a crop. So you have to be able to take advantage of any opportunities that may be presented. Now, I'm going to have a few busy slides here. And hopefully, when this gets posted, you'll be able to go through and take a look at this. And what I'm showing you here is one table off of a spreadsheet where we track quarterly price movement. Okay, so we're going to start at January, April, July, and October. And what I want to show you here is the price relationship between CME wheat, Chicago Mercantile Exchange wheat, which is the soft red winter wheat contract, and our Northern Plains hard red spring wheat. And the data that feeds this is in another tab on the spreadsheet. But what I want you to look at is the long-term average, which is down here in the bottom right-hand corner, is 71 cents per bushel with Minneapolis wheat or hard red spring over Chicago. Have we seen that yet this year? We actually did early in the calendar year, and we'll take a look at that in a minute. But for the most part, we've had Chicago wheat that has been trading higher than Minneapolis wheat off and on for a bunch of the year. Fact is, if you take a look here, Chicago wheat in January was 20 cents over Minneapolis. In April, it was 29 cents over. And by July, it had flipped around to 22 the other direction. Now, we don't have October yet. And at this point, it looks like, unless something dramatically changes, Chicago is going to be above it again. But what we find is that there's a pretty big range. Now, Betsy, let's go back to 2008, right? These are right. These are the aberrations, right? This is when Minneapolis wheat went to 20-some dollars a bushel, and it actually drugged Chicago wheat along with it. And it not only impacted this price relationship, but it impacted some of the others that we're going to look at in a little bit. And I've got the quarters where we had the largest changes highlighted in red. And you'll notice that looks to me like I'm going to have to fix that, because there was our biggest right there. Now we're going to have a negative number here, -9, unless this changes significantly. But our red numbers, the yearly average and our first and second quarter averages all occurred in 2008. In 2011, our third quarter or fourth quarter average was the highest. And then back in 2017, we had an interesting aberration where we had Minneapolis wheat go well beyond Chicago wheat. That actually happened in early July. And I think we got up to what, 781 for a very, very short period of time. And it was whatever it was, and it collapsed pretty significantly. It got up really high for a very short period of time and it dropped right off. But the number that we want to look at is this, and the fact that it's very hard to sustain these futures contracts being out of balance. Okay, so what this is the candlestick chart is the nearby futures on, actually it's the December futures on Chicago wheat. The blue line is the closing for Minneapolis wheat. And if we go clear back, this is over a year. So this goes back harvest time last year. We had Minneapolis wheat considerably higher than Chicago. This is in the defers now. This is in December, right? We didn't have nearby wheat at 6, but this December was in 6. Why weren't we selling wheat, Betsy? But we had $6 wheat and we had $5.40 wheat. So we actually had a significant advantage, Minneapolis over Chicago at that time. And then that adjusted and we started tracking together. And then Chicago went over. And then when prices collapsed in the summertime, Minneapolis stayed up there and we flipped it the other way around. We actually had about a 40, 42, 43 cent advantage Minneapolis over Chicago after Chicago had been 10, 12, 15 cents in the D's over Minneapolis. Okay. So, oops, I got to go back. All right, just hang on to that. We will take a look at how we take advantage of that a little bit. So here is corn futures and CME wheat. Okay, so it's the same data set. We look at prices, nearby futures prices on a quarterly basis. And what you'll find is that historically, Chicago wheat will have a $1.12 premium over Chicago corn in the nearby futures. We had a range this year in December futures, March futures of 21 that went all the way from $1.42 to $2.19. Chicago wheat was trading at an exceptional premium to Chicago corn. Now let's take a look at when that normally occurred. Well, back in 2007 and 8, when wheat took off, we traded at a significant premium over corn. In 2011 and 12, as we're going into the drought, it was the other way around. We had corn actually trading at a premium to Chicago wheat. So those are both weather or supply driven events, with the exception of this year. We had plenty of wheat on hand. We had plenty of corn on hand. Chicago wheat traded outside of the rest of the futures complex. And we needed to find a way to take advantage of that when we had those kinds of ranges that were outside of normal. So how do we do that? How do we take advantage of futures price imbalances? And what can we then do with those? And then the next question that a lot of people have asked us this year is this really hedging? Are you really hedging using these kinds of spread trades? How much does it cost? Because there's some differences there. And how's it work so far this year? All right, let's start with the first question. How do you take advantage of it? Okay, so many of the spreads trade as natural spreads. Okay, so You can do a calendar spread on Chicago wheat. You can do a spread between Minneapolis wheat and Chicago wheat. You can do a spread between Kansas City wheat and Chicago wheat. That's a natural spread. The corn wheat spread, I'm not so sure that's a natural. You may have to margin that one differently than you would one of the other ones. I know that a lot of times we'll utilize corn calendar spreads to take advantage of price inversion, and we can get into those for probably somewhere between $300 and $500 initial margin. That's not much money to be able to extract somewhere between 10 and 30 cents per bushel out of the marketplace in a relatively short period of time. So you're going to have to talk to your broker about how you get into these things if you're not comfortable doing it yourself, but they're utilized all the time by investors and by hedgers. So the way you do this is you buy the undervalued contract, which in this case was spring wheat, right? Because Chicago was trading at or above Minneapolis wheat, which is abnormal because the long-term history tells us 72 cents, Minneapolis over Chicago, okay? And then you sell the overvalued contract, which in this case was Chicago wheat, okay? So then you just hang out and wait until your exit price target is hit. So let's just, for the sake of easy math, let's say we got in at 0 premium. Chicago wheat and Minneapolis wheat were trading at the same price, which, by the way, if you go out in the deferred contracts right now, and we'll take a look at if we have enough time here at the end of the presentation, you're going to find that all the way out to July of next year, Chicago and Minneapolis wheat are even or near even. And actually, in some cases, I think all the way out to May, we may have a premium into the Chicago over Minneapolis still. So once you get those in place, you set a price target. Now, you're going to hang out and try to wait for it to normalize back to 72 cents? I wouldn't. I would have a price target in mind of somewhere around, you know, if you know what the range was, and we know the range was $1.42 to $2.19, somewhere in between there, and I'd say maybe not get greedy and pull 25 to 30 cents per bushel out on that spread trade. Keep in mind, I'm laying a $500 on the table to do this. And if I pull 30 cents a bushel out, that's a $1,500 return. And that happened very, very quickly this year. We had growers that had those positions on for less than 90 days. And they were able to pull their 25 to 30 cents per bushel of those contracts out. And quite frankly, they did it twice. Okay? So you don't try to outguess the marketplace. You put in a reasonable expectation to generate revenue, and you lift those positions and you take that money and add it onto your final price. All right, is it really hedging? Well, I would have some people argue with me, but I tell people if you're using stored production, insured production, or expected production to cover those positions, it's hedging. Now, when we write up action steps, we always have an other category at the bottom. And if I'm doing 15 of these contracts for hedging purposes, and I want to take my friends to Cabo next March, I might do 2 more of them in my other category. Not that I'm ever going to go to Cabo because travel restrictions, right? Plus, that's also closeout time, right, Betsy? You can't do it at that time. So, you know, yes, you can use these as an investment, but make sure that in your primary account, particularly if you're borrowing money, that you're utilizing that as a hedging position and you're using your own capital if you add on to these positions. So we've talked a little bit about the cost. Most of them are relatively inexpensive to put on. If you're going to do a soybean corn spread, you get to margin both halves of that equation. That can become relatively expensive. You might be looking at somewhere around $3,000 to $4,000 just in initial margin to do a corn and soybean spread. Why am I bringing corn and soybeans up? Well, I don't have the data here, but right now we're out of balance in terms of our new crop price ratio between corn and soybeans for 2021. And I'm not using new crop Dece in November, I'm using July because we've got price inversions in both of those as my hedge month. So we're out of balance there right now, but not enough to put that spread trade on, particularly with the cost that comes with it. So we're ignoring that for the time being. All right, so how's it work so far this year? Well, depending on how aggressively growers have used the strategies, some are on the second and third time around on the CME corn wheat spread. That thing has gone from and we don't put it on until we're at $2 spread. And we've been over $2 3 times or 4 times, and we've taken 25 to 30 cents out 3 times. Well, that's 75 to 90 cents a bushel, depending on the number of bushels that they're doing. And we've encouraged producers to try to limit it to about half of their expected production. So if they're normally growing 200 bushels per acre, we're encouraging them not to go above and beyond 100 bushels per acre in that particular scenario. So we're on the second time around on the CME corn wheat one. We've got CME wheat trading, I think, about a dime over Minneapolis right now in the D's. So we're not exiting that one anytime soon, but it wasn't that long ago until we started this last rally up in August that Minneapolis was trading higher than December in that December contract. So when it comes to the Chicago wheat versus Minneapolis wheat spread, when we first looked at this, we encouraged producers to do 100% of their expected production on that spread trade. So if you'd budgeted 75 bushels per acre, Betsy, we wanted you to put that spread on 75 bushels per acre, time your planted wheat acres, and obviously you got to round it into 5,000 bushel increments. And we had some growers that did that. Some took a lesser amount than that. But that's so far has been the most positive thing we've been able to generate in terms of spring wheat this year. So we're looking right now at beginning to hedge 2021 spring wheat. And the way it looks right now, we may have an opportunity to do this again. And by the way, the spread moves generally when prices go up. Chicago wheat will go up faster than Minneapolis, just like nearby contracts in corn and soybeans go up faster than the deferreds. And that's when we're seeing these things get out of balance. And then when we have a price correction the other direction, that's when it corrects itself and we're able to exit these positions, take some profit, set it aside, and assign it to a specific crop and a specific crop year, because that's important too. I don't want to go to the end of the year and have the farm business management instructor look at it and say, wow, you had this kind of hedging gains. Where is it assigned? Well, it needs to be assigned to a specific crop and to a specific crop year, because oftentimes we'll do strategies to generate additional revenue on last year's 2019 production or this year's 2020 production, and we're already starting to look forward to 21 and 22. So we want to make sure that that revenue gets categorized as to where it goes, so that if you're going to do an enterprise analysis, because while you may be profitable overall, if you want to do an enterprise analysis and take a look at how your marketing has been, you need to be able to segregate and assign that revenue to those specific crops in that specific crop year. All right. The spread trades have been in conjunction with either selling futures or hedge to arrives or cash forward hedging and selling. And we also are selling out of the money call options to improve revenue. We've done this forever, and it works the vast majority of the time. And I've got some growers right now that are a little nervous because they sold some $10 July 21 call options here about 2 weeks ago. Well, all of a sudden that 30 cents that they generated is 50 cents, which means that they're doing what? They're contributing maintenance margin to that call option position. So let me ask this question rhetorically to the folks that are watching this online and to the group that's in the room. Would you have the growers that you work with, or if you are a grower, would you sell spring wheat futures for $6.25 to $7 in the deferred months today? You like $7 wheat, Betsy? Absolutely. We all do. Okay. So if that's the case, you can sell December of 21 CME wheat call options with a strike price of $6 for over 25 cents per bushel. Well, if we stay even, Minneapolis versus Chicago, That's $6.25 wheat, Minneapolis wheat and Chicago wheat. If we get some sort of a premium built back into the market, say our 70 cents, now all of a sudden we're at $7. When we convert those positions into a futures position for Chicago or Minneapolis, if in fact those options are exercised. Quite frankly, the vast majority of the time they're not. We just collect the revenue, add it on. But if they are exercised, we're selling at a high enough strike price that we're satisfied and happy to make that sale. Which is why $10 futures next July with a 30-cent premium and supposed carry going out to November would be a profitable sale for the vast majority of growers in the Northern Plains. Here's one of the other strategies that's data-driven on what we do. So a number of years ago, we had a lot of growers that missed a bunch of price targets, and they sold a lot of undervalued corn in August. They cleaned out the bins, sold corn for $2.78 a bushel. They got into harvest time. They had a big crop, and they had to sell some at harvest, and they didn't get much for that either. And we had pretty good carry in the market, and they were bemoaning the fact that they can't pay commercial storage rates and interest and sell out to July or September and make that work, which is the way the market's designed. It's not supposed to work that way. So we went back and did a study, and we started keeping track of this. And what we watched was we wanted to take the end of week close on September futures on corn. And we wanted to know what the probability would be of getting hung with short corn contracts and short $4 call options if we sold those when we had an opportunity to do so for $4 or better. And what we learned is that since 2014, by the way, the markets didn't break until the midpoint of 14. We had $5 corn futures the first half of 2014. And by the time we got into August, we averaged $3.69. Last year, when we had the big rally in 2019, we started August out at $4. We were in again at $4.10 the second week, and by the time we ended, we were down to $3.58. The long-term average, $3.59. This year, $3.26. We actually went up in August this year. We started at $3.08, we ended at $3.46, and I don't know what's dinging over here, but it's distracting. So one of the things that we do is when we have an opportunity to sell September futures for $4 or above, which, by the way, did we have that opportunity this year? 403 high, September contract on January 3rd. $4 strike price call options that day, 26 cents. If you had entered into those contracts at that time, you'd have picked up 55 cents a bushel on the bushels that you sold at harvest time, or the way we actually calculate it is, all right, what are you selling at harvest? What are you selling at the end of the year for cash flow purposes? Or what are you selling right after the first of the year? Depending on how you manage your income streams, we'll sell, that's one of our maxes right there. The other max is maybe 100 bushels per acre in our country. Up in your area, probably 75. Because if I can't get out of those, or if I get exercised on those call options, those have to be treated as hedges for 2020 or 2021 or 2022 production. So I got to make sure that I'm covering those positions with the following year or two's production if I get exercised on the calls, or if I can't get out of those futures positions and take my profit. In 2019, we entered into the $4 futures and exited them twice at 30 cents. Plus we got to keep the $4 call premium at 25, 26 cents, and we came out of it clean. And actually, if we'd had the courage, we could have done it a third time, couldn't we? But nobody expected that price to drop like that in 2019. So oftentimes we can do this more than one time, and we get to tack that on to our harvest time delivery sales or our sales that we're making towards the end of the year right into the first. But again, you have to do it with some constraints so that you're not getting overly aggressive on this. But if you can add an extra 50 cents a bushel to new crop corn sales, which you can make right now for about $3.35, $3.40, if you can do that on 50 to 75 bushels per acre, that improves the bottom line and profitability pretty significantly, doesn't it? Now, from a cash accounting standpoint, it's not going to show up this year because that's going to be sometime next spring or summer. A lot of times what will happen is around planting intentions time, we'll get knocked out the first time, and then we'll have an opportunity in a rally sometime after that to get back into that position. So this is, again, why it's important that if you're going to do enterprise accounting, that you categorize what that revenue is supposed to be assigned to, because as a cash accountant, it doesn't allow you to see how you've done in a particular crop unless you can segregate that revenue. So really got to have a couple sets of books, right? You got to have the books for tax accounting, and you got to have the books for enterprise accounting so you can keep score on how well of a job you're doing in price risk management and revenue generation. Okay? So that's one of the big things that we do. I like to, if we can do it more than one time, that's a bell ringer. But if you can add 50, 55 cents a bushel one time on anywhere from 50 to 100 bushels per acre, that's a pretty significant amount of revenue. And that comes with relatively low cost. All right, let's talk about spring wheat marketing. This has been a frustration, hasn't it? We've just not had good opportunities to directly market spring wheat. Our old crop price targets at this point, and I'm using March as my futures month right now, 549, 559, 569. Those are kind of my low end expectations in terms of price. And these are based on nothing more than where price has already been. If you go back and look at the March chart, do some rudimentary retracement numbers, you're going to come up with levels of resistance near those. I want to sell just under those levels of resistance so I can get some stuff sold, because what is king? Cash. And I want to generate some cash. And then I'll go and defer some income by going out and selling some July 21 $6 strike price or higher calls. But I got to use Chicago calls for two reasons. Number one, the liquidity and the open interest in Chicago is immensely bigger than it is in Minneapolis. And then secondly, it's actually trading at a premium to the Minneapolis futures right now, or right at what Minneapolis futures are. And I can do that on up to half of next year's production, because if I get exercised on July $6 calls and I get any kind of recovery in terms of the price relationship, I'm at 6.25, maybe 6.50. I'm going to be able to push that out to SEP or DEES or March and pick up carry, most likely. And I can end up with something close to $6 cash wheat if everything falls into place. Quite frankly, we've done a study on how often a July $6 Chicago wheat call gets exercised. Guess what? It ain't very often. As a matter of fact, you have to go back to, I should pull that data set up, but it's a long time. And I think maybe once or twice in the last 25 years, you'd have been exercised into June on a $6 Chicago call. It's not very often. It's not very often. Okay? So $6 calls are safe calls. If you're not comfortable with the sixes, sell 620s or 640s and maybe just add one or two on to generate the same amount of revenue. Okay? So let's talk about new crop 21. And this drives people absolutely crazy. But I'm going to let the marketplace tell me which futures month and which exchange I should hedge new crop 21 on. Because as I've stated several times, right now, July Chicago futures are trading just 2 or 3 cents lower than Minneapolis futures. And if I can get Chicago sold for somewhere around 580, and I have any kind of price relationship correction, I get to tack that on to my final sale when I convert that into a Minneapolis contract. Particularly if I spread trade that, if Chicago goes to a nickel or 10-cent premium over Minneapolis, I'm actually doubling up what I can add to that hedge. But right now, we're not anywhere close to that. and I don't know if I'm going to use July or if I'm going to use September. For a while, we had a 10-cent inversion between September or July and September, where July was 10 cents higher. Right now, it's about 4 or 5 cents the other way. So it's like, that's getting close to normal. Normal is probably 8 to 10 cents between July and Sep on both of those futures exchanges. And I'm going to have to wait until we get close to one of those price targets and then make the decision, which contract month, which exchange, and will we be doing a spread trade to start entering into our 2021 hedging program. By the way, we got up to about $5.75 on the Chicago futures here before it dropped back down. We were really close to getting something done, and we didn't pull the trigger on it. Our goal ultimately is to try to generate enough revenue to equate to $6 cash wheat by the time we're done with it. Because a lot of the growers that I work with, especially in the Southern Valley, $7.50, $8 break even on wheat, all inclusive of expenses. Because we don't get to grow 75, 80, 85 bushel wheat because too humid at night. We've turned into a little bit of Iowa, which is why we're growing 200 plus bushel corn. We don't get to grow good wheat because of that. And our land cost is significantly higher than it is in the Central and Northern Valley or Central and Northern Minnesota and North Dakota. Okay. So we're doing everything we can to try to make wheat profitable, but it's a challenge just because we have not been given an opportunity to price directly into the future since 2017, and that didn't last very long. Let's talk about corn a little bit. I'm leaving soybeans for last because we're going to go off the slides and we're going to actually look at some futures and stuff here in a little bit. So our new crop price targets, now this is D's futures, 369, 379 and up in dime increments. Normally we're going to start at 403, 404, 405. We got that. That's the only pricing we got done back in January was that first incremental sale. And since then, we had to readjust our price targets down. We did get the 369 here a couple days ago. We have not got the 379 yet. I got one farm that has 40,000 bushels of storage for all of his crops, and he farms 4,000 acres. So he needs to be a very, very aggressive marketer at these levels, and he'll be a very aggressive utilizer of that selling the carry strategy as well. Now, he also started selling corn 2 years ago for this fall. So he's got a bunch of futures positions in place that are in the fours, but because we know that, we're much more aggressive when we have opportunities a long ways out. So we're doing that. If you have storage, we don't have enough carry right now between nearby D's and July of 21. It's only what, about 20, 22 cents, something like that. Maybe, yeah, I think it's about 20, 22 cents. I need 28, 30, 32. With the new CME storage rules, we got 32 cents for a little while last year. And I want to be in the high 20s before I shift completely out to July for old crop hedging. But I'll still use price targets out there. And we're pricing in the 380s, 389, 399. Just so that we can get some hedges on. And I don't care if you're going to use hedge derived contracts or if you're going to use cash forward at that point. I'm going to tell you right now that the North Dakota ethanol plants and the Northern South Dakota ethanol plants are the drivers of basis. Because there ain't no corn in North Dakota. I've been across North Dakota on I-94 6 times since April. And the last corn I saw harvested was in June. And the corn that I saw last week on my way out was frozen. And they were chopping as fast as they could. You know where the best looking corn on I-94 was? Right outside of Dickinson. Because it got put in on time and they had some rain. And that got froze. But that I think is going to be okay because that was mature enough. That was some good looking stuff out there. Well, you take $40 dirt and you grow 170 bushel corn on it. That's pretty good money, isn't it, Freddie? But there's no corn in North Dakota. And I took a run up into your country in July, it was June, end of June, and I saw more unharvested corn than I saw harvested corn. And I went all the way up to Oslo and that whole area, and there's not a lot of corn in the North Valley either. So right now, the ethanol plants in North Dakota are the drivers of basis. And I can actually get better basis in eastern North Dakota in a couple of locations in western Minnesota than I can in southern Minnesota right now and northern Iowa. That's because they're going to have to import corn and drag it away from its normal sources. So why do I bring that up? Well, that's half the pricing equation, right? So we've got a primary marketer or primary elevator calling around asking growers, what kind of basis do you need for you to start selling to us? Because they want to be able to sell some of this export corn to China. Plus, they got to feed this ethanol thing. So we're holding out on some of our basis opportunities for something in the 30s, as I mentioned earlier, off the march. And depending on what kind of a corn crop we actually get nationally, I think their yield estimates are going to be closer than their acreage estimates, because we don't know how many acres are going to get harvested in Iowa. A lot of that corn in Iowa, they are going to want to harvest, but they've had 4 or 5 inches of rain on drought-stressed down corn on several million acres. Guess what it's doing? It's molding and growing. That's not conducive to very good marketing. So that's going to be a problem. So we're going to sell the carry like we talked about earlier. And we just got started, or we will be shortly, on 2021 marketing using the July futures. We actually started in January. We got 1 increment sold at $4.19. I've got 35 farms that have 1 or 2 contracts at $4.19. And we're thinking, God, I wish we'd have done more. All right, so, well, let's start selling at $3.89, $3.99, and $4.09 then. Because by the time we roll that out to December, and if we've got storage, you can hit it another time, because I can lift my futures hedge to arrive it into December, and then roll it out that one time that the elevator let me do. And I'm taking my margin capital off the table at that point in time. And I should be able to pick up somewhere between 35 and 40 cents a bushel by doing that. And if I can invert a little bit and put on a spread, I can maybe add another dime to 15. So then I'm looking at somewhere close to $4 or a little bit better cash corn. We're going to do the same thing in 2022. And because I only got 5 left, I'm going to have to hurry up. Let's do this quick. Whoop. So 2022, we're starting at 409. I didn't check to see where we're at today, but we were up to 405, 406 a few days ago. So we're getting really close to starting our new crop 22 hedging using July 22 futures. Now, it takes money to do that, doesn't it? I got to go to Ag Country and say, here's my written marketing plan. I expect to grow X number of acres of corn in 2022. And I'm going to sell maybe 25 to 50% of my insured production at these price levels. And I'm going to need X amount of capital to do that. Okay, so you need to make sure you got a hedge loan for that. All right, let's go on to soybeans before we get the hook here. All right, so we had a lot of growers that disregarded this advice. Okay, they said, what should we sell beans at? I said $9.59, $9.79, $9.99. I'm confident we'll get the $9.59. We might get the $79. I don't think there's a chance in Hades that we're going to get the $9.99. Turns out I was wrong, pleasantly wrong. We got all 3 of those price targets, and we tacked a couple more on. 10.29 and 10.44. That 10.44, by the way, is a retracement level going back about 3 years. I had to throw a 5-year chart up, measure the high, measure the low, put my 2/3 retracement in. It was like 249 or 1049. I said, I'm not that greedy. I'm going to do a 1044. But I didn't want to wait that long, so I threw the 1029 in too. I wonder how close I got to that 1020. It was up 24 at one time today. We maybe got pretty close to that. I'm going to be surprised if I don't get the 1029. We're also selling 1060 and higher call options. I got a text earlier today. We sold $11 July calls for 25 cents. 20 bushels per acre, 25 cents. $11. If I get exercise on those, yeehaw, that's a good sell. 2021, we're getting started on those too. We're using July just like we are in corn, just like we might be in wheat. 1009, 1024, 15-cent increments. The July futures are trading 45 cents higher than Nov, and I'm not touching that spread with a 25-foot pole because that could go to $2. And I don't want to margin that one. Now, if it goes to $2, I'm going to jump on it. Not on a whole bunch of bushels, but I'll do several. Because even if it only narrows up by 50 cents, that's $2,500 a contract for maybe a $1,000 investment. That would be a pretty good return on my money. 2022, we've got some ideas there, but we're not ready to implement them at this point. I'm running out of time. I want to look at one other thing. Let's do the thank yous to start with. Thanks to North Dakota Grain Growers, Minnesota Wheat, Ag Country, Northern Crops Institute. And then I'm going to hit the escape button. Let's quick take a look at soybean futures while they're getting ready to give me the hook. And get Frey up here, Frey up here. Where is, there we go. Where's my tab? Right there. All right, so here's soybeans today. Okay, so Nov was up 19. We got as high as 1014. That's a pretty good run. Let's look at July. July's at 1015. We got some fills today. Got all the way up to 1017. But look at November. 968. Okay. So we closed at 1015 minus 968, 47 cents. A week ago, that was 30 some cents. 2 weeks prior to that, it was 23 cents. I had guys wanting to get in at 23. I just, no, don't do that. Let's let this thing run and see what happens, and then we'll decide what we're going to do. I'll do one more thing here. Let's click on these July options. And we'll let that load. And there's our $11 strike price calls today, 25 cents, 80 of them sold, 1060s, 35 cents. The probability of getting exercised on a 1060 July call is there, but if I get exercise on it and I've collected a 35-cent premium, I'm at 1095 futures plus any carry that I get as I roll that futures position out. All right. That's what I got. Thanks for everybody's time and attention.
One question for
I got a question. Okay, what is it?
So, basis projections, question mark. Wheat and beans during roughly the November timeframe varies greatly based on region, but is there a 20-cent improvement in spring wheat and anything in beans that you can think could happen?
As I was thinking about wheat basis last night, that's one of the more frustrating things there is. There's 3 places to sell wheat, 4, okay? Appleton, Minnesota, the state mill, what's it, Ulen? West Central, and there's a little elevator, Pro Ag, that's got a fertilizer plant with no rail access on I-94. And they haul wheat down and fertilizer back. Those are the best 4 basis spots in the area that I track. Everybody else takes wheat because they feel like they should take wheat and they don't want to tie up bins. So you can look at wheat basis that'll run anywhere from 20 under to 60 under. And we had 20 under basis in the Central and Northern Valley in July for August and September delivery. That's no longer there. Now, historically, we'll see our better basis occur December to January, maybe into Feb. And a lot of times we get a 10 under. Sometimes we get a 10 over. But a lot of it's going to be dependent on the quality of the wheat that's available and how aggressively they need it to blend off on the stuff that's not so good. Okay? So we may see a 20-cent improvement, but it's not going to necessarily be at some of those better price locations. It'll be on locations that now have room and they want to utilize that space. Soybean basis, we had some better than normal offers early that we had a lot of guys take advantage of, and then it got better. And everybody was complaining. It was like, I took 75 under and I could have got 60 under. And now it's 60, 70, 75, 80, which is more normal for harvest time. And by the way, is anybody keeping soybeans in the bin? With a flat market and prices that are approaching $9.50 or better, Better not. You better not. That's your cash flow crop. Sell the beans and worry about selling next year. Sell some out of the money calls. And don't store those beans. If it goes up, so what? We'll sell next year's and the years after at that point in time. Okay?
One more for you. Keep you up there. How much risk is there in having the July to December spread get more inverted if the Iowa harvested acres or yield losses are underestimated and old crop gets a bullish story?
Well, right now, soybeans has the advantage for new crop 21. Okay, so they're trading at a premium to corn. So corn is going to have to buy some acres. So we'll return to a normal carry between July and December just to drive acres, if nothing else. Because right now, soybeans are $150 an acre cheaper to grow in my neighborhood than corn is. And if I can get a 10 in front of soybeans, and I've got a low 3 in front of corn prices still stink. Unless I'm growing 15, 20, 25 bushel more than normal, I got a 365 break even. That's what my futures are. So corn prices stink. Soybean prices are profitable, as we saw from Betsy's slide earlier. So I don't think we're going to see a huge inversion between July and Dece. If we do, I'm going to spread trade it because it ain't going to last. And we're going to be able to pick up that inversion and tack it on to our 2021 marketing. And by the way, we had almost a record-wide inversion in 2012 when we had the drought. That corrected itself in 2012 when we had $7 futures. So, okay, is that it? I think I got everything.